With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 24th, 2024. Heading into Memorial Day weekend. And want to take a moment to acknowledge and remember all those that gave the ultimate sacrifice to protect our country and keep us free. It's not about burgers and hot dogs. It's about so much more than that. And of course, next week's going to be a shortened week in the market because of the holiday. But let's talk about the action this week. It was a bit topsy-turvy. So taking a look at things, the Dow Jones was down 2.3% on the week. The Dow is only up 3.6% this year. It's really been lagging behind. The S&P 500 was flat on the week. It was up 0.02. The NASDAQ composite was up a bit. It was up 1.4% this week. You can thank the chips for that, semiconductor chips. NVIDIA reported a good quarter. We'll talk about that in a minute. Small caps are down a little bit this week, down 1.2%. The volatility index, the VIX, down 0.5% this week, but it was way up there yesterday on Thursday, and it pulled back some today. Again, bit of a roller coaster ride this week. Long-term bonds, flat on the week. TLT just didn't go anywhere this week. It was down 0.01, so let's just call that flat. And we take a look at the sectors. Retail sales were down 1.3. There's been some weakness being discussed amongst some of these companies reporting as far as the consumer is concerned. Utilities, which have been hot lately, down 1.1%. Discretionary down 1.7%. Staples down 1.4%. I mean, everything's down. Energy down 3.7%. Financials down 2%. I mean, I'm trying to look for anything that was actually up this week, and the only thing that was really up on the major sectors of the market was technology, up 1.5%, and semiconductors up 6%, mainly driven by NVIDIA. Again, we'll talk about that in just a second. Gold down 3% this week, silver down 3% also. So both of those were down this week. So what moved markets this week? Well, I mentioned it twice already. NVIDIA was on everyone's radar this week. Everyone's kind of watching that. I thought that it would probably be a catalyst to move markets up or down, as did many, many other folks. And many, many other folks, including yours truly, were completely wrong on that one. NVIDIA did report a good quarter. I thought maybe they could have a little bit of softness on revenue as other competition starts to eat into the market share a bit. But this move towards artificial intelligence is just so strong right now. There's so much spending being done that their numbers continue to improve. They reported a really good quarter, and it's really become an impactful stock on the S&P 500. But even though they reported a good quarter and the stock was up like 10% on Thursday, the stock market was down. It was down big time. It started off up in a major way, and then it reversed and it ended down in a major way. All this happened on Thursday, the 23rd. And what sent the market down, I think the catalyst there was some economic data that came in a bit hot. The PMI services data, this is the expenses of services, and we're a service-based economy. It was hot. The market didn't like it, made the market concerned about, again, interest rate cuts not happening. And it really reacted negatively. As a matter of fact, it was so bad that we got a big, ugly red candle on the charts. Now, for those that you've been listening consistently, week in and week out for a long time, we've talked about this before. This is an outsized down candle on the market where I call it an engulfing red candle. That's what they call it. I know it sounds kind of like voodoo to some of you folks when it comes to these charts, but let me kind of back up for a moment. The last time we had one of these was April 4th, and we talked about it on the podcast. April 4th we had an engulfing bear candle, and the market proceeded to drop over 5%. The time before that, the last time we had an engulfing red candle, bearish candle, was July 27th of 2023. And the market proceeded to drop 10% from July, finally finishing its decline in October of last year, down 10%. So we just had one in April. The market dropped 5%. We just had one Thursday. So although the market, the S&P held a key level this week, we talked about that 5260 on the S&P. It finished at 5304. It was below it on Thursday, and this candle kind of leaves the door open to suggest that we're not out of the woods yet on this corrective phase that we've been in. I think this corrective phase started in April, and I'm not convinced that we're out of the woods on it yet. So as far as what we did this week, for folks that have had new money come in, I did put some of it to work in areas that were already kind of down and out. Certain holdings that were just kind of down, that have been down for whatever reason the last few weeks. We did some buying there. But other areas in the models that have been strong, we did not buy. We added money to bonds, and we added money to a couple of holdings that have been down, but we did not buy the other stocks that have been doing pretty well because I want to see how things shake out. Again, I'm not convinced that we're out of the woods on this just yet. So we're still holding on to some cash. Didn't do any additional buying in the models. For folks that were already fully invested when their portfolios came in, we went ahead and got those moved to our models because they're set up the way that we want them. But for those that have had a lot of cash come in or put cash in their accounts here in the last few weeks, just did some specific and targeted buying, didn't go all in because I think we might get a little bit better buying opportunity on some of these. So all of that said, I will say that I think things are still looking very constructive for the market and the economy. The economy seems to be pretty strong. Look, we had jobless numbers were pretty low this week. On one hand, that's good for the economy. On the other hand, it's not so good if you're expecting interest rate cuts. I am still a little concerned about inflation. We're seeing some inflationary pressures still in commodities. And I'll tell you something else. I read a story this week about shipping container shortages that are spiking the transportation costs of goods and services across the pond in a major way. Not to mention what's going on in the Middle East and having to reroute the shipping because of all of that. So there are definitely some pressures within the economy that I think can still weigh on inflation. I think that the Fed is in a place where they really can't make a move right now. They're going to have to hold steady. I can't see them cutting rates anytime soon. The market will like to see it, but I don't. So I think that there's a high probability that we're still going to see this market drift a little bit lower. And if we do that, we want to buy it. If things somehow stabilize over the next week or two, we'll be looking for other opportunities. But I think all told, things look good. I think things look good. I just like to see this market drop one more time. There's just too many things kind of pointing to it. So I like to see it happen. Just kind of finish this corrective phase that started back on April 4th. And we want to buy that and position ourselves for what I think will be a pretty strong finish to year end. So if that starts to happen, watching 47.53 on the S&P, that's a 200-day moving average. I don't know we'll get down there. I think we can get down to around 5,000, maybe 4,800 and change. We'll see. We're watching and waiting, and we'll see what happens. So I'm going to go ahead and wrap up. That's what I've got for you. But between now and next few minutes, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early, take that big trip, buy that second house at vacation property and Airbnb it. Maybe it's get involved with paying for a college education for a child or grandchild, whatever the case may be. You know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.